We making moves. We making major moves. We making moves. We making major moves. We going all in. Like we got nothing to lose. We making moves. We making major moves.
What's up, everybody? I'm Mr. Man. Welcome back to my channel. Today I'm going to read one document to you. Just one document. And it's from Sygnum Bank. Who is Sygnum Bank? Sygnum Bank is the world's first digital asset bank, founded on Swiss and Singapore heritage. It operates as a global digital asset banking group with the mission to empower everyone to own crypto with complete trust. Sygnum holds banking and securities dealer licenses from Swiss regulators FINMA and capital market services licenses from Singapore Monetary Authority, or MAS. Now that you know who Sygnum is, let's see why. Okay, so I told you about Swiss. Where was it? The Swiss regulators. Let's see why that's important. Switzerland's an important banking center for a number of reasons, including political neutrality. Switzerland's political neutrality and stable climate make it a safe haven for money that's free from outside influences. Strong and influential sectors, so Switzerland has a well-developed economy with a strong, reputable financial sector. The country is home to many of the world's top financial institutions. Switzerland has a long history of banking secrecy and client confidentiality dating back to early 1700s. Switzerland has a reliable legal system and political institutions. Switzerland has sound currency. Switzerland's banking system is universal with few capital restrictions and other regulations. Okay, so now you know why Switzerland. Allow me to introduce you to Sygnum. Invest in crypto with a regulated Swiss bank. Sygnum is a global digital asset banking group founded on Swiss and Sygnum heritage. Our mission is to empower everyone, everywhere, to own crypto with complete trust. On board with Sygnum today to buy, trade, and earn crypto to future-proof your investment strategy. So this is the document I'll be reviewing. It's called Crypto Market Outlook 2025 for the bull run and into the future. So it's going to give us a market outlook leading into the future itself, okay? And for 2025 coming now. So begin to plan. On my last session, I was talking to you guys about creating a strategy, an exit strategy. Do you have a trust set up? Do you have a will set up? Do you have a USB stick with videos on there to plan for your wealth? What happens to it for your family should something happen to you set up? Do you have things set up for this? Are you looking to pull profits and get taxed out of your butthole? So we know the bull market's coming. So let's dive into this. Part 1. Bull market likely to continue into 2025. Oh yeah, I go right to the source, okay? Bull market likely to continue. The bull case for crypto primarily hinges on the expected allocations to the asset class by new investors. As the asset class is still small relative to others and most of the world's large institutional investors are not yet participating, the opportunity for further steep price appreciation is from engagement by other investors. Previous market bull cycles, each delivering returns percentages in the thousands, have also been driven by new investor groups discovering the asset class. You and me of the world. Bitcoin holders were initially software developers, followed by those committed philosophically to a decentralized ethos of Bitcoin. The 2017 bull cycle was driven by retail investors, again, discovering crypto, and by 2021, this is when I jumped in and got my butt handed to me. Investor anticipation had broadened to include hedge funds and family offices. Every wave of new money entering a small asset class has produced extraordinary returns, and the same is expected as traditional investors, traditional institutional investors allocate to crypto. A trend that has begun with the launch of the spot Bitcoin exchange trade of funds this year. The conditions for institutions to enter the market are currently in place as follows. Familiarity with the opportunity. So awareness is high, at least as far as Bitcoin is concerned, after the entry of major institutions such as BlackRock, crypto playing a central role in the last election cycle, numerous supported statements from key opinion leaders and Bitcoin ETF issuers marketing the asset to institutions. You see that all the time now. The ability to trade and settle. So the ETFs enable investors to gain exposure without having to invest in systems and personnel to be able to trade, settle, and risk manage crypto assets, bringing down the practical barriers. So they can just walk in and say, I want money like this, and they can have somebody else look after it for them. Simple. Plug and play. Regulatory clarity. Although regulatory clarity around crypto asset is still lacking in the U.S. Progress in this direction, coupled with a strongly supportive stance from the new president's team and a significant number of elected legislators, is removing the obstacle. The electee is Trump, all right, and his new people he's putting in. Gary Gensler's leaving January 20th. We're getting a new czar in place. I believe his name is Paul Atkins. A lot is happening, and these guys are pro-crypto. You better believe crypto's going to shoot up. Favorable market conditions. The easy ability of liquidity coupled with bullish market conditions facilitates and accelerates new allocations. The prevailing macro backdrop of healthy U.S. GDP growth, the expectation is accelerating earnings. A continued rate cut cycle and the prevailing bullish momentum in the crypto market create favorable conditions for institutions to make crypto allocations. And the catalyst, the U.S. election has provided a catalyst as the new administration has vowed to implement a host of policies to support the crypto industry. In addition to allocations by institutional investors, there is an ongoing diversification from gold to Bitcoin. I'm sure you all heard by now, Microstrategy and Michael Saylor is saying dump gold, buy Bitcoin. BlackRock is dumping everything they have into Bitcoin. Fidelity is jumping into Bitcoin. Van Eck is jumping into Bitcoin. State Street's jumping into Bitcoin. They're making this stuff easy for people, okay? Senator Loomis here has the Bitcoin Act. The bill aimed at establishing a strategic Bitcoin reserve has suggested that even the U.S. government may make such a move by selling gold certificates to buy Bitcoin should the Bitcoin Act pass. From my recollection, the last audit on the gold from the U.S. Treasuries was not accomplished beyond 1950. So, and they're selling certificates, not the actual gold. Do they have the gold? Meanwhile, the inflow of new money into the crypto market is met by extremely limited liquid supply, leading to repeated demand shocks and a strong multiplier effect on every dollar. Bitcoin's theoretical market cap is in itself relatively small compared to the potential size of the allocations, but its circulating supply is smaller still. In addition, a lot of the circulating supply is highly liquid, with committed long-term holders making up a large share of the investor base. Indeed, the Bitcoin balances on exchanges, a measure of the readily tradable supply, have been declining for most of this year, had dropped off again after the elections. We have seen that the inflow triggered by the launch of ETFs have repeatedly caused demand shocks this year. Very interesting. Part 2. Watershed year ahead. Institutional allocation. The crypto industry has long been anticipating the time when institutional investors regard crypto as a legitimate asset class, and allocations to crypto assets in portfolios become standard practices. 2025 may be the year when this happens. We have seen the beginning of the crypto allocations in the balanced portfolios of large traditional financial institutions this year, as well as the initiation of crypto investments by a small number of pension funds. Filings show that an increasing number of funds from institutions such as BlackRock, Fidelity, and Morgan Stanley have amended their prospectus to allow exposure to crypto investments. The typical allocations range between 1% and 3%, but in some cases the ceiling is set much higher. For instance, 25% for Morgan Stanley portfolios. Well, that's huge. Depending on the size of that portfolio, that could be 32 million. That could be 25% of whatever that portfolio is. And I had Googled this. for the average holdings for Morgan Stanley. And 25% of that is 32 million. So some pension advisors, such as Cartwright in the UK, are now recommending a crypto allocation to pension funds. Although the U.S. regulator of private pension funds has not yet changed its guidance, discouraging crypto investments. Some state pension funds have been investing in Bitcoin ETFs, so Wisconsin and Michigan, with lawmakers introducing bills to direct the state pension funds to consider the crypto allocation in several other states: Arizona, Louisiana, Missouri, Ohio, Oklahoma, and Florida. 2025 is likely to see regulations in the U.S. that clarifies the status of crypto assets. This is all the same document. This would be transformative for the industry with a number of potential benefits, including enabling institutional allocations to the crypto asset class, easier banking access for crypto projects, clarity on regulatory requirements for different types of tokens, reduced legal overhead for crypto businesses, reinvigoration of innovation investment, and a move of talent into the industry. The stated policies of Donald Trump, the numerous indications that campaign promises are on track to be delivered, and the resignation of Gary Gensler suggests that the expectation of clear and a positive regulatory environment for crypto assets are likely to be fulfilled. Once Gary Bear leaves the SEC and we get Paul Atkins in there January 20th, you better believe crypto is about to fire off like you never believed, like you've never seen in your life. This is about to get real, so real. All right, December 15th, today is the start of this, with the FASB, Financial Accounting Standards Board, coming into play. Now, crypto assets are visible on balance sheets for high net worth investors and companies. Not investors, but companies. Right? It's on the balance sheet now. We can all see these things coming into play. And then when Maker goes live in UK, and stablecoins are a thing out in the UK, EU, not the UK, and that's a thing, and real world assets are being moved on these layer 1 blockchains, you better believe it. US isn't going to miss out on this. So the best case scenario would see tailored rules that take into account the difference between crypto assets and traditional securities, which in turn enable decentralized protocols and applications to pass economic value to token holders while complying with reasonable disclosure. Remove the basis for the lawsuits against various crypto trading venues operating unregistered security exchanges. Allow US-based crypto exchanges to be regarded as legitimate surveillance markets by the SEC, therefore removing the obstacle from the issuance of further crypto ETFs. A lot more ETFs are going to flood the market. And check this out. Many jurisdictions have been well ahead of the US in enacting crypto regulations, so Switzerland, Singapore, the UAE, Hong Kong, and the EU. But as the US appears to take the lead, other countries are considering policies that will allow them to stay competitive. There have been indications from the UK and China already of intentions of more liberal crypto regulations. Meanwhile, enshrining Bitcoin as a central bank reserve asset would be truly transformative. Already a number of US states as well as Brazil are introducing similar acts, and it's likely that if the US takes this step, further countries will follow suit. Recognizing the surge in demand that this would catalyze is likely, that's a weird word, okay, catalyze likely to compel governments to think strategically about how they might position themselves before price moves. Okay, I'm right here. BlackRock's recent detailed report on Bitcoin as a portfolio diversifier covers the same points the industry has long been arguing. However, coming from the world's largest asset manager, it will support traditional institutions move into crypto. You better believe they're going to support that. They're going to be holding one of the largest amounts of crypto. Options on the Bitcoin ETF that recently started trading will do the same, as they allow for hedging and creating asymmetric risk profiles. Central banks and local governments considering Bitcoin reserves may also start a genuine trend of treasury allocation to Bitcoin. Tesla, BlackRock, and Microstrategies started this trend in 2020. However, since then, only a few microcaps followed suit. It is likely that despite the appreciation in Microstrategy's stock price, the example set by the Treasury was more of a deterrent than something corporate treasurers were keen to follow. For example, making huge leverage bets on Bitcoin and investing billions versus a top-line revenue of just over 1 million USD and operational losses in the core business. However, the recent initiatives to add Bitcoin as a central bank reserve asset appear to have already encouraged a list of small companies to make treasury allocations to Bitcoin, and the trend could expand to large corporations. Shareholder proposals have been submitted to Microsoft and Amazon, although the proposals were shut down at Microsoft. There's a growth trend of shareholders advocating for Bitcoin treasury reserves. Microsoft wants nothing to do with this strategy at all. Nothing. In 2025, we expect to see the beginning of mainstream issuance and trading of tokenized assets. Why is that? Because stablecoins are coming out like I was saying earlier. The potential benefits of tokenizations have long been recognized with broad consensus about the opportunity. The Boston Consulting Group, BCG, forecast a $10 to $16 trillion market cap by 2030. I think they're being very conservative. And in a BNY Mellon survey, an overwhelming 97% of institutional investors agree that tokenization will revolutionize asset management. However, the cold start problem has held growth back. Too few products and too little liquidity to incentivize buyers to build out the necessary systems to trade and settle, and consequently, too few buyers to attract users. Eventually, the demand from crypto native investors for fiat yield kickstarted the market. However, this demand was incentivized by temporary market conditions of elevated fiat levels, coupled with a crypto bear market. We've all lived through this now. And depressed crypto yields. If you've been in this market since before 2021, you've lived through this, okay? That's what we had. When the court case got dropped on Ripple and the market dropped down and we were living in that 4-year bear market there, that's what they're talking about. This rate cut cycle we're going through now, coupled with buoyant conditions in the market, in the crypto market that include attractive yields available in crypto, will necessarily reduce this demand. So we're in the period right now with the Fed where they're cutting rates and cutting rates and cutting rates. I want to say aggressively cutting rates. It's not like 0.25 or they're 0.5 each FOMC now. Bank of Canada is doing it as well. So are other banks around the world. So for now, our base case remains that policy changes will not substantially alter the trajectory of the economy or monetary policy over the next year. The appointment of Scott Bessent as U.S. Treasury Secretary has also raised hopes that the policies on tariffs and tax cuts will be less aggressive for the U.S. However, take note of this. However, should bond yields rise further, such as a clear rise above 5% for the 10-year yield, this could signal deeper challenges, acting as a canary in the coal mine for escalating risk. This could hurt risk assets and trigger an equity bear market. All right? So you know where the next bear market's coming, potentially, should this exist. Although a bear market in a risk asset can also lead to a rotation into crypto from other assets, which means should this bear market exist, no one's going to wither it anymore. They're going to let go of whatever they have and dump it into crypto. Based on past track records, a sell everything approach is more likely. You're going to dump it all. Boom, there's that flash crash we were talking about there, okay? And into crypto assets. Why into crypto assets? There's that rise of Bitcoin I was telling you about before and earlier. We got BlackRock, Van Eck, Fidelity. We got the Reserve talking about Bitcoin. Microstrategy talking about Bitcoin. Bitcoin will rise. Dump everything, and it rises. If you go into crypto. That's how that one works. Now this one might sting some people, but I'm not here because I'm trying to sting anybody. I'm here because I'm giving you real talks, all right? No feelings involved. This is you preserving as much wealth as you can and as much money as you can, so do not get attached to these crypto assets. You're here to make money, follow the flow of currency, okay? Concentration risks. And again, this isn't my opinion. I've given you my opinion on Tether. Now listen to another opinion on Tether. There are multiple instances of concentration risk in the crypto market which are important to monitor. Maybe the most significant of these risks is the high market share of Tether among USD stablecoins after the 2023 US banking crisis, which impacted stablecoins holding substantial portions of their reserves at US banks. Tether's previous 45 to 50% dominance has increased to 75%. Look at that. Look at that. Look at that. That's huge. The market is especially alert to this risk, with concerns about the completeness and reliability of the information Tether provides about its reserves, especially with Tether's history of settling a 2019 lawsuit alleging that its reserves were used to cover losses at affiliated crypto exchange Bitfinex. While there was no evidence to support a recent Wall Street Journal report that the FBI was investigating Tether for anti-money laundering violations, it highlights the market's concerns and sensitivity to any negative developments surrounding the dominant stablecoin. However, with Cantor Fitzgerald, and I've shown you guys this before, owning a share in Tether and providing custody for its U.S. Treasury holdings, like I said, every time the Treasury mints or prints, Tether mints. Chairman and CEO Howard Lutnick's appointment to the new administration might mean that Tether's relationship with the U.S. government, it says will improve. We'll see. We'll see where that goes. Now this one is good. Large concentration of Bitcoin holdings are also a risk, as the sudden sale of 50k Bitcoin of the German government this summer highlighted. So holdings by ETF issuers such as BlackRock are not a concern in this regard, as they hold the assets on behalf of the ETF investors. However, large holdings by MicroStrategy and possibly certain governments could create an uncomfortable concentration risk. Now, what were we just talking about prior to this? The U.S. strategic reserve of Bitcoin? A high concentration of Bitcoin at that point? MicroStrategy in particular is a risk for the crypto market, as the way they operate could attract regulatory attention for possibly sidestepping rules that apply to traditional investment funds. This could lead to increased scrutiny or changes in how the company is allowed to operate. The leverage the company uses is a further risk, while there is no indication of either a regulatory crackdown or any other impetus on the horizon that could compel MicroStrategy to liquidate Bitcoin. With their holdings at the 2% of the total Bitcoin supply and a much higher share of this liquid supply, this is a risk to monitor, right? Not my words. Hypothetically, the dominant Bitcoin holdings of Satoshi, estimated at over 1 million Bitcoin, could also become active at some point in the future as well. So you want to hear about the bubble that could build? Let's go into the bubble. Excessive exuberance can transform a fundamentally driven bull market into a bubble. And that's where we end up in end of 2025 into 2026 with this Bitcoin bubble, because of this concentration. Okay? There are no signs of this happening in Bitcoin at this point. Notice the language, at this point, as demonstrated. For example, by the funding rates, which have risen but remain well below levels seen earlier in this year or in previous cycles, indicating that leverage buys is more muted. However, the lackluster user adoption trends across various crypto use cases have diverted interest into meme coins instead. Check this out. Some refer to this gambling-style approach to crypto investing as a symptom of financial nihilism, profound skepticism about the value of money and traditional financial systems, whereby many individuals, particularly young generations, have lost faith in conventional investment practices and the intrinsic value of assets. This mindset often leads people to engage in high-risk speculative investments, viewing them as valid alternatives to traditional wealth-building methods. It's regrettable that a sector lacking fundamental value outperforms the rest of the market substantially. As this carries the risk of the meme coin bubble bursting. Woo! Y'all ever see the meme coin bubble? Look at that. Look at that. That's just from 2024 alone. Okay, this is a longer video than I wanted. This is the last section here I want to go over, called geopolitics. In the current environment of extraordinary political tensions, these risks to the market cannot be ignored. Other than occasional brief corrections caused by geopolitical escalations, markets are pricing in optimistic scenarios. The oil markets are more concerned about global economic slowdown than about an all-out war in the Middle East. And risk assets have continued their upward trajectory even in the face of extremely worrying geopolitical escalations. This also means that there's a substantial downside to financial markets on a more serious turn of events in the Middle East or Ukraine. Meanwhile, even barring a hot war in the Far East, the impact on global growth from an economic war with China will be significant, especially for the Western Europe. The crypto market, listen to this, is likely to react negatively to serious escalation in the first instance. However, Bitcoin accumulation is likely to continue. The crypto market is likely to react negatively to serious escalations in the first instance. So 2025, we are going to see the continued instances of war and talks of war between the West and the East. And people are still going to accumulate Bitcoin. Michael Saylor said he's going to continuously buy the top of Bitcoin. And if he's true to his words, he will. And he's going to continue to concentrate Bitcoin. And it's going to be a hard one. It's going to be a hard one. So that's the 2025 for you outlook. 2026 is way more desirable. It's all about the Independence Day, independent Constitution of 1776 in the U.S. And that's a well better play. From there, I'm moving my income or my profits from certain crypto assets, I underline and bold the word certain crypto assets, into silver and gold at this point, mainly silver. And I will let you know why in the next segment. So just to get you guys up to speed, my Patreon group is free to join. However, there is a tier 1 group, which is a $10 a month group. And currently I'm offering a 25% discount off of that from now till December 30th when Mika is implemented and stablecoins come to life. Just to give you guys a rundown of what we discuss in this group there. I usually every morning just mind dump of information on what's coming down the pipelines, market direction, where currency is flowing, how to allocate your money, should you decide to allocate your money. We discuss estate planning, wills, we discuss your trust, we discuss corporations. We have every Friday night, we have a new person speaking with us at Town Hall. Last week we had a rep, Sean of the XDC from XDC Australia, talk to us, and we got a lot of juicy nuggets. Man, that was a beautiful conversation. This week coming up, we have Jake Claver coming through to talk to us again. Notice I said the word again. And with this individual, we talk about wealth preservation. We talk about strategies. We talk about things that you may or may not already be familiar with. But keep in mind, he's someone who owns and operates a family office. So this is what he does on the daily. He knows how to preserve wealth for individuals who have a net worth of over 21 million, I believe he said was his low entry to join his family office there. So I bring a lot of value to you guys. I help you plan for your future. I help you plan for your now. I help get you guys introduced to DeFi. I help you learn how to make passive income. I teach you real estate. Like, I'm here. I am here if you're ready to learn. I'm now offering 25% off. And again, it's still only $10 a month. Now you get 25% off of that as well. I'll see you guys on the next one.
We making moves. We making major moves. We making moves.